Hello, I Anand Jain from Hanumangarh, Rajasthan welcomes you to your favorite Shridevi Classes YouTube channel where we inculcate and trust and confidence in science, engineering and management subjects. Today in our subject project management, we'll understand the requirement of money for growth of any business or for exploitation of available opportunities or day-to-day affair, and this money requirement is fulfilled by project financing. And there are two way for project financing: internal financing and external financing. And we'll learn the two form of internal financing, depreciation and retained earning. And we'll learn several external financing including debt financing, equity financing. So let's start project financing. Financing is the process of providing funds for all business activities, and these funds are used to make purchases or for investments. In other words, we can say financing is a way to leverage time value of money. Money in hand is more valuable than money that would be available in future, and financing means to put future expected money flow to be used for project which are started in present time period. Project financing also takes advantage of that fact that some individuals in an economy will have surplus of money, and those individuals or corporate or banks having surplus of money, they wish to put that money to work to generate returns, while businessmen may demand money to undertake investment. Again, business firm also have a hope to generate return by that investment, and this surplus money and demand for money create a market for money, and activity of that money market for arrangement of funds for one project is known as project financing. Financing is a crucial aspect of running a successful business, and this financing aspect is equally important to both a startup who have just started their business activities or a well established enterprise. The right type of financing can help a business to grow, invest in new opportunities, and also to manage day-to-day operation more effectively. In fact, financing means can decide overall financial feasibility of any project. Good wise financing can make a project successful with great ease. Means of financing refers to various sources of funding. These sources can be internal sources of funds or they may be external source of funds to an organization. Internal financing could be by its own retained earning or by depreciation of assets, whereas external fundings may be debt funding, equity financing, or others may be grants, crowdfunding, or government loans, or use of government schemes or programs. Internal financing refers to use of funds which are generated from within the business itself. When business profit is invested in business activity, it is called retained earning financing. And if business fixed assets are depreciated for tax benefits and then the saving in tax is utilized for financing the business, then that is called depreciation financing. And retained earning and depreciation are two key internal financing sources. A business enterprise by its efficient operation generate some profit. A part of profit is distributed among shareholder and owner as dividend, and the remaining amount can be accumulated by business organization as retained earning, and the company can reinvest this retained earning obtained as a part of profits back into business. Then this sort of financing is known as internal financing by retained earning. For a profitable business project, retained earning is the most dependable source of funding. Retained earning doesn't result in any debt or equity dilution, so there is no need to pay interest on debt, so it won't have any explicit cost of funding. Neither retained earning has to pay funds as a dividend to external party, so there is no fixed liability on retained earning funding. Retained earning do not involve selling of shares or diluting of existing ownership stake. So there is no interference of external parties. The company can retain complete control over its operation without dilution of ownership. So there is no security problem. This will enhance goodwill of company, and company can reinvest its profit according to its need, and the same retained earning can be used to absorb shocks of unexpected losses in business. So it is most dependable source for funding any project if project is earning profits. Availability of retained earning for financing a project depends on the total amount of profit earned by the company and the dividend distribution policies of the company. The financing by retained earning is possible when company earn sufficient amount of profit and only a small amount of that profit is distributed as a dividend. Then remaining amount can be financed to the project as retained earning. But many a times company profit got its limitation and they have to pay dividend to enhance or maintain interest and confidence of stakeholder. So most of the time retained earning funds may not be sufficient to finance the project entirely. When profits are reinvested in the project as a retained earning, this will limit the amount of fund available for dividend payoff distribution to stakeholder and owner. So this will reduce confidence and interest of these stakeholder in company affair, and that is also a basic requirement for project activity. So one has to make a balance between retained earning financing and dividend distribution. Retained earning of business profit can be a suitable source of financing when a company has strong profitability and very good cash flow and there is no other significant investment opportunity available to project activity. Neither there exists debt obligation nor there is urgency for dividend payout distribution to shareholders. Then this retained earning financing can be a viable option for an existing established company that want to reduce their reliance on external financing. Depreciation or amortization is another technical process of internal financing. Depreciation represent systematic allocation of cost of fixed asset over their useful life so that the accumulated depreciation account money can be used to replace any fixed asset after the useful life of that. We use depreciation for tangible physical fixed asset and the same process for intangible non-physical assets such as patents and trademarks is known as amortization. Technically, depreciation and or amortization are not direct source of financing, but they can indirectly contribute in financing by freeing up cash for other financial purpose. This financing cash flow is achieved through tax benefits or by reduced taxable income when we use depreciation on our fixed asset, and this ensure lower tax payment. Now this difference in tax payment increase our cash flow, and that cash amount can be used to fund business operation or can be invested in new opportunity and become a source of funding. Depreciation, devaluation of worth of physical assets, or amortization, devaluation of intangible knowledge assets of a company as a source of financing got an advantage that it doesn't require any external debt financing or equity dilution. Only technical paper manipulation will generate cash flow for financing, but it has a limited amount, so it's a limited source of financing, and relying too heavily on such non-cash type of investment can reduce the book value of organization, and that may result in reduction of overall profitability of the company too. External source of financing involve seeking fund from outside of the business. Now, external source of financing includes borrowing fund from bank and other financial institute, and this is called as debt financing, and we have to pay not only principal amount but regular interest on such debt financed amount. Another external source of financing is equity financing, where we issue bonds or raise funds through public offering known as shares, and fund collected by this way is called as equity financing. That doesn't involve payment of regular interest but do involve payment of dividend to stakeholder or shareholder. Now, another external source of financing is trade credits. It is obtained from supplier or service provider of the project. There are some other external source of financing like government projects, grants, crowdfunding, leasing. In this learning video, we'll understand debt financing and trade credits only, and equity financing and other external financing will be discussed in another learning video of the same playlist. The advantage of external source of financing to a project or a organization is that it can provide access to a large amount of capital, and this is especially significant when internal source of financing as retained earning is small in magnitude and we need large capital, and such large capital is available only by external funding. However, there is a disadvantage of external funding that company will have to pay not only principal amount but interest also on borrowed fund, or if shares are issued then shareholder has to be provided with dividends, and that dividend will come from the profit and earning of the organization only. Debt financing means borrowing funds from external source like banks and other financial institutes and repaying the same borrowed amount back to banks and financial institute with interest over a specified period. Such debt financing borrowing may include loans, line of credit, or issue of bonds. The advantage of debt financing is that it allows the company to access large amount of capital, and that too at relatively low cost of interest and smooth terms and conditions without much hassle to finance its organization activities. Bank loans are one popular debt financing method. Bank loans provide immediate access to capital that allow businesses to finance their regular operation or investment for growth opportunities. However, there is a great disadvantage of debt financing, that is, the firm has to regularly make repayment of interest for the borrowed amount. If the rate of interest is high and firm earning is small and profit cannot repay interest, then it will create a vicious circle of debt trap for an organization. Apart from paying interest, the firm has to repay a part of principal amount regularly so as to repay the entire borrowed amount. Different type of bank loans such as terms loans, secured loans or unsecured loans or line of credit, all these offer wide range of flexibility in terms of rate of interest or the structure of repayment. The term loans, one popular bank loan, are lump sum payment that is repaid over a fixed period with a fixed interest rate, while line of credit provide businessmen an access to a predetermined maximum amount of fund that can be drawn whenever the business need that, but the interest is charged only on the amount which is borrowed by the organization for the time being. So line of credit provide a limit to maximum amount which can be borrowed, but interest are considered only on the actual amount which is borrowed. The interest rates or repayment terms for bank loans vary depending upon the type of loan and the lender, bank or financial institute. Typically, when a firm get a secured loan and provide some guarantee of fixed asset against loan amount, then interest rate is considered lower compared to interest rate for unsecured loans, because in secured loan, borrower provide collateral guarantee against the borrowed amount. so that provide security to banks or financial institutes against the borrowed amount. Another big advantage of bank loans is that they provide business organization and firms with a very reliable, quick and easily accessible financial mean, that too at comparatively lower interest rate and favorable repayment terms as compared to the other source of external financing. So majority of small business organization use bank loans as a preferred mean of external financing. However, secured loans of lowest interest rate and favorable repayment terms require some collateral guarantee, or they require a good credit score of borrower, and credit score are earned only when a borrower regularly repay its borrowed amount and interest as per the term agreed between financial institute and borrower. So for secured loan, a company or firm is required to make regular interest and principal amount repayment to lender. Otherwise, bank or financial institute can acquire the collateral guaranteed fixed asset of that organization. In all bank loan, when capital is borrowed, such borrowing from banks involve regular interest payment, and which makes additional cost of financing, because apart from principal amount, the borrower has to repay the due interest for the amount for which he has used external financed amount. There is also a concrete repayment obligation against secured loans, which means business or organization need to repay the borrowed fund according to the agreed upon terms, and this repayment include both principal amount and the charged interest as per the agreed rate of interest and the time of borrowed amount. Bonds are transferable debt security instruments. They are issued by corporation or governments to raise capital from investors. So in bond terminology, investor is basically lender or creditor for financing, and bond issuer is the borrower. The bond offer a fixed interest rate for payment, and there is a predefined repayment terms. When an investor buy a bond, they are lending money to the bond issuer for a fixed period of time, that with a fixed rate of interest. So in bond term, principal or face value of bond is the total amount which is borrowed, and coupon rate of bond is rate of interest on borrowed amount. Coupon in bond term is interest payment, and maturity of bond is due date. So at the end of maturity or due date period, the investor, the lender, will receive their initial investment plus interest back from the issuer or borrower. Since bond are transferable, so bond have a market value that represent the current price of bond, and on that market value, bond can be transferred from one lender to another lender. Bonds are issued by the borrower who get money from investor, and these borrower may be government departments or corporate or companies. Borrower consider their credit worthiness, the interest rate and economic climate, and issue its bond to individuals or financial corporates which act as investor, and these investor provide the total capital that is needed by bond issuer on specified rate of interest and maturity time period. So bond are purchased by investors, and against that bond they supply capital or loans, and bond has specified rate of interest and maturity date. One can narrate advantage of bond financing or pros of bond financing. Bonds can provide a fixed and predictable source of capital for any organization. They often have lower interest rate compared to bank loans, and bondholder who issued bond and provided finance to organization have no ownership stake in the organization, which means the organization which got finance doesn't lose its control on organization management. There are some disadvantages of bond financing. Cons of bond financing: the interest paid on bonds is a fixed cost and that must be paid regardless of organization financial performance, whereas in case of shares, when finance is obtained against issue of share, the dividend paid to shareholder depends upon organization financial performance. Bond prices are influenced by market condition and that affect the cost of financing. Say for example, in market rate of interest rises, then definitely bond prices will fall, which will cause a loss for bondholders. Now, issuing of bond is a very complex and expensive process. It involves extensive legal and financial requirement and that increase administrative complexity. So when our organization got better trustworthiness in market and need large amount of capital, that too at lower interest rates, then only it can issue bonds. But bonds issuing is a complex and expensive process, involve several financial and legal requirements. Trade credits are asked by business firms as customer or buyer from seller or supplier, and this trade credit allow the purchase of goods and services without paying the money upfront directly at the time of purchase. So here in trade credit, business firm can negotiate with supplier to extend the payment credit terms and allow the organization to access goods and services without payment of cash for goods or services. And in trade credit terms, due payment can be made later as per the term of the sale, and this will provide a flexibility for the management of cash flow. Essentially, trade credit is a delay payment system where the buyer or customer agrees to pay the seller or supplier the due payment at a later date. Usually that trade credit time duration may be 30 days, 1 month, 60 days, 2 months, or 90 days, 3 months, depending upon the type of goods or services dealt in trade credit system. There exist several benefits of trade credit. Trade credit can be an easy and convenient way to obtain finance, as it doesn't require collateral as it is required in secured bank loans, or a former complex legal application process as it is required in bond formation. We can say trade credit can help to improve the cash flow of business by allowing the business to defer payment until a later date. So it will increase and provide fuel to growth of an organization by facility of delayed payment, and it frees up the working capital for other attached investment opportunities and make cash flow smooth and convenient. Trade credit can also help to build a better relationship between buyer and supplier, which can lead to better terms and pricing for supply of goods and services in the future. So we can say trade credit also built good relationship between buyer and seller. So it is mutually beneficial. Some drawbacks are also associated with trade credit scheme. Sometimes trade credit also become very expensive as suppliers start charging heavy amount of interest and other fees for extending credit for their supplies. Sometimes when buyer couldn't pay due payment in scheduled time or pay beyond the credit limit duration, so such late payment or non-payment can damage the healthy relationship between supplier and buyer, and this will hurt buyer credit rating and he will not get trade credit at favorable terms from suppliers. Trade credit solely depends on the willingness of supplier to provide favorable terms for payment of supplies, and this may vary for different organization and supplier, and many a times for startup or new firms having lower credit ratings won't get facility of trade credit. The limitation on the amount of trade credit which is available and the higher rate offered by supplier can limit buyer ability to finance its larger purchases on trade credit basis. So it's not a instrument for large amount of capital financing. Equity financing in an organization involve raising funds through public offering of shares or issuing shares to private investors. And when company give its share to investor provide financing to organization. The advantage of equity financing is that the company doesn't have to repay this fund amount which it has raised by equity financing, but the disadvantage is that company must share its ownership and profit with such new shareholder or stakeholders. So equity financing has a advantage of freedom from repayment of funds which are raised by equity financing, but have a disadvantage. Company has to share its ownership and profit with shareholders. So we can say that two main type of external financing available to companies are: one is debt financing and the second is equity financing. Debt is a loan or bond that must be paid back, often with interest, but it is typically cheaper than raising capital by any way because it has some tax deduction considerations, whereas equity financing doesn't need to paid back the amount raised by equity financing, but at the same time it relinquishes, give up or surrender ownership stake to shareholders. In company financing, both debt financing and equity financing have their advantages and disadvantages, and most companies use an appropriate combination of both to carry out its financial operations. Overall, the choice of means of financing depends on various factors. It includes the size and complexity of project, the amount of finance required for that project, the financial internal resources of the company, and the terms and condition of external finance which is available as different options, and it is essential to evaluate all these financing options carefully, and after careful study one can choose the best financing option that meets the needs of project with best conditions while minimizing the financial risk of the company. In this beautiful informative learning video of project financing, we have explained both internal financing and external financing, and now you could understand what are advantage and disadvantage of retained earning, debt financing and equity financing. You could also understand how depreciation can be used for project financing. In another video of project financing, we will understand the other available source of finance such as leasing, grants from government and charitable organization, crowdfunding and other programs. If you found this learning work useful, do share it with your friends, and if you need exam centric notes, do join our YouTube membership. Thank you very much. Happy learning.